Welcome to the seventh installment of the Toy Storage Nation series, TSN Conversations Unplugged. This series is based on questions we most often get at Toy Storage Nation. Today's topic is financing, keys to success in securing. Today's participants are Shawn Hill, principal and founding member of the BSC Group, Neal Gussis, executive director, capital markets, SPMI, and Amber Crucian, AVP-Self storage at Live Oak Bank. Thank you all three for being here. Before we begin, I was hoping all three of you could briefly introduce yourselves and give us a bit of background. Amber, can we start with you?
Yeah, of course. Thank you guys for having me. My name is Amber Crucian. I'm AVP for self-storage. I'm a loan officer at Live Oak Bank. I've been there for about 5 years and in the financing industry for about 10.
Thank you. And Shawn?
Well, thank you for having me. My name is Shawn Hill. As you said, I'm a principal and founding member of the BSC Group in Chicago. We are a mortgage banking firm that specializes in helping owners of self-storage obtain financing for their projects.
Thank you. And Neal?
Hi, I'm Neal Gussis. I'm Executive Director of Capital Markets at SPMI Capital. I have been in the industry for over 30 years and have focused on loan advisory, loan brokerage for mainly self-storage and other commercial properties. Had the privilege of being Shawn Hill's partner for a while, and together we've advised a lot of folks in the industry on storage and other commercial real estate and boat and RV. And we've also used Live Oak Bank on many occasions. So look forward to this conversation.
Thank you. I'm going to get right into the questions because there's a lot to cover. And I get more calls probably on financing than just about any topic, especially during, the last couple of years. You mentioned something, and I'm going to kind of go away from the flow that I was going to, but you mentioned advisors versus being a bank. Can you explain to folks, Neal, how advisors play a role and how you do then work with the banks? Because I think sometimes there's a little confusion on, who should they be going to and how everybody works together.
Well, going out and seeking financing either for development or refinance is something that most people don't do every day. It's similar to residential housing, where you might buy or sell a house every 5, 10, 15, 20 years. And, the market changes, and, like every other type of profession, we could talk the language of lenders every day, and we kind of know what's the market is kind of trending. And particularly when you look at something like boat and RV storage, it's very unique, and you really should think about broadening your relationships beyond your bank to use an advisor, even if you go to your bank, because we're going to be able to structure a package, manage a process, and get you better rates and terms, usually because we're in the market every day. So that's a little infomercial.
Amber, is there a benefit for you as the bank working with someone like Neal or Shawn through a project? Do you find it comes to you in a way that is easier to kind of get secured versus someone trying to do it on their own at times?
Yeah, I think there's a huge benefit to having an advisor or a broker on the deal. I think that it makes communication a lot more streamlined between the bank and the client. And in a lot of cases too, I think especially with folks that are newer to the industry or getting into a new asset class, maybe they've done traditional self-storage in the past and they're looking for RV and boat storage, and an opportunity there, working with someone who really knows the industry, to Neal's point, I think is incredibly beneficial and valuable.
I think one of the things that gets confusing is people think of mortgage brokers as going out and getting just the best rates and shopping the deal. And that's just a fraction of what we do. It's also controlling the process and managing the process all the way through to closing. which there's a lot of moving pieces to get to closing.
Thank you. Shawn, do you have anything to add in on what Neal said?
Yeah, I think that both Amber and Neal hit it right on the head. You know, they only print money in one place, we like to say in the business, but our job is to understand how different capital providers package it up and sell it. So interest rate is somewhat of a commodity. You know, borrowers are often very focused on the interest rate, but it's really the structure in the deal, behind the deal, that can really determine the project's success or failure. A deal that's structured the wrong way is going to have a tough time from the beginning, and many times that can be a big disadvantage for the borrower. So our job is to help the borrower get organized, to identify weaknesses in the transaction, help mitigate those for the lenders. There's a lot more to it than just going out and shopping for the best rate.
Thank you. Thank you. I'm going to now kind of go back to the sequence that I was thinking about earlier. With regards to where in the process should folks start to seek financing? And this is a question I get a lot, you know, should I have things kind of mapped out? Obviously a feasibility study, but, you know, site selection, unit mix, that type of thing. And then also, can those plans be changed once you start the financing process if it's looking like that's not going to make it? And are recommendations made to help improve a project's success for financing? Let's go ahead and start with you, Shawn.
Yeah, well, I think that definitely. So I don't think it's ever too early to start talking to an advisor. I think, as I just pointed out, you know, we only have so many hours in the day to decide which clients and projects we're going to work on. So when we pick up a project, it's typically with somewhat of a critical eye, and we will cover a lot of the basics initially. You know, do the rents make sense? Does the location make sense? Does the product type and the unit mix that they're proposing make sense? A lot of the very basic ideas and elements of a project are things that we will examine early on. Right. And that can be very valuable feedback for the sponsor as they start, you know, I mean, believe it or not, we spend many hours in the day trying to convince people not to do projects, or, you know, because if I pick up something and it's going to be very difficult to get it done because I think that there's a lot of weaknesses in the transaction, it's really not a good project for me to work on. It's not a good use of my time. Because at the end of the day, we need the project to get financing in order to get paid. So I would much rather try to give a sponsor critical feedback and redirect them in a manner that's going to help them get their deal done, rather than blow proverbial smoke and, you know, talk them into a deal that doesn't really make any sense. Because where am I going with that? The lenders aren't going to get excited about the deal, so it's sort of a waste of time.
Right. Thank you. Thank you. Neal or Amber, do you have anything to add in there?
Yeah, I definitely do. I mean, to Shawn's point, I think it's never too early to develop a relationship with a broker or advisor and the lender that you're planning on working with. And to Shawn's earlier point too, I think that, I mean, structure and term are in a lot of ways just as important as rate. And I think that understanding the project kind of from the get-go builds into how the lender is going to be able to come up with the use of proceeds, come up with the term on the loan, really understand the ins and outs of the project and the scope. And I think that, I mean, I think it's really great to start early on, just because a lot of times people come up with a unit mix and an idea for a project that they get really, really excited about. And sometimes I even have files come to me that are fully baked. And we take a look at them, a broker or an advisor or a feasibility study expert is looped in, and they say, hey, it would actually look a lot better if we took, you know, this path forward as opposed to what's been built out so far. And a lot of times those folks are so far into the process that it is more difficult to pivot. So I'm a big fan of earlier the better.
Thank
you.
Yeah.
I mean, just adding on to Shawn's point, and Amber's point is, you know, people it's kind of like when you go to the racetrack and you bet on a horse, and then by the time the race goes off, you're placing 2 more bets because you've worked yourself up to that horse is going to win. And I think in our world, we're really reality checks, because we'll look at the numbers and we'll say, you know, you're not going to get those rental increases. You're not going to have that velocity in lease up, and really kind of beat up the assumptions that just may be too aggressive.
Mhm. Thank you. Do you have particular providers for feasibility studies that you, Amber, that do you have like a preferred feasibility study provider list, or, you know,
Yeah.
and Neal and Shawn, do you guys do that in-house, the feasibility studies, or do you have preferred folks that you work with for feasibility studies? And I ask this in particular because boat and RV storage, Class A, and I can give the definition of that again in a moment, but it is a new asset class. Although it is storage, we really consider it its own entity because the business model and how it pans out is so different. So just curious on, you know, feasibility folks that are out there. You know, do you have a preference?
For
And
sure.
you don't need to give names. I'm not saying that. I just, you know, are they better off coming to you first and seeing, hey, listen, we're better off using this feasibility person?
Yes, I definitely think so. I mean, we're pretty particular about who we accept studies from. So we do have a pretty short list of vendors. We always share that really before, you know, after the first conversation that we have with the customer. It's a topic that we touch on and talk a lot about throughout the process. So we definitely do.
Yeah. And Neal and Shawn, same question. Or do you do it in-house?
No, we don't do it in-house. And I think particularly like you indicated, is really important for boat and RV storage to have feasibility experts that understand the industry, particularly because you're talking about buying and developing over larger land parcels, and the square foot rentals are, you know, significantly lower than say self-storage or other property types. So really, you need to have somebody really that understands the dynamics of this sector. And as you indicated, there's, you know, a relatively fewer number of properties relative to even self-storage.
Thank you. And Shawn, any thoughts to add?
Yeah, we do not do our own feasibility studies or do feasibility studies for the client. We do pick apart their feasibility studies, and we will do our own analysis to try to verify or challenge the findings that are in the study. With respect to vendors, some are definitely better than others. We typically are trying to steer people to vendors that are going to be readily acceptable to the lender. So, you know, there's nothing worse than paying for a feasibility study and then going into the process and having the lender say, well, you're going to need to get another one because I don't like that brand of feasibility study. And I definitely think that, you know, as we're talking about boat and RV specifically, working with somebody that has access to good data is very important, because obviously garbage in, garbage out, right? So being a niche of the self-storage sector, you're looking at a little bit different demand drivers, a little bit different demographic data, and, you know, industry data about, you know, vehicles, et cetera. So working with somebody that has access to good data is certainly important.
Sure. And for anybody listening that is needing some recommendations for feasibility folks in the Class A RV and boat storage segment, happy if you want to give me a contact, email me or call me. I'll have my contact information at the end of this. Also, you could reach out to Amber as well and ask the lenders, or excuse me, the feasibility folks on their list as well, to save you a little bit of time. The next question is the types of loans that are available. You know, there's the especially during the high interest period that we've got right now, conventional, hybrid, adjustable, it starts to all blend together, but wanted to understand a little bit about the differences between the types of loans. And during a high interest period of time, you know, do you tend to prefer one over the other? Is there something of going in initially with a hybrid, you know, and then being able to go to a bit more of an adjustable? Amber, I'm going to start with you on that.
Yeah, I mean, there are a ton of options for debt out there. I think it really comes down to each individual project and the scope, guarantor, the kind of priorities that they have that they're looking for with structure, term, and rate. Live Oak Bank specifically, we lend in both SBA 7A, we're the largest lender in the country for 7A. So that kind of started out as our bread and butter. We also do SBA 504, and we've gotten really into the conventional market lately as well. So those are kind of our main focuses. And I think, again, especially with rate and deciding to go fixed or variable or hybrid, I think it really just comes down to the project and the guarantor. We have options for all of those. It really comes down to preference. I personally think that there is something to be said about the positive side of a variable rate in the environment that we're in right now. 2 years ago, that might have not been the same answer, but where we're at right now, I feel like there is hopefully a positive swing in the next couple of years for those that do end up going with a variable or a hybrid rate.
Explain what an SBA loan is and what the benefits are, but also, is it harder to get an SBA?
Yeah, SBA loans. So there are two different types of SBA loans. There's an SBA 7A and an SBA 504. 7As, one of the reasons that we do so many of those is that we're a preferred lender with the SBA. So whether you work with Live Oak or really any lender, I think it's really important if you go with that loan product to look for a preferred lender status. It basically just means that instead of the lender having to go to the SBA for approval and for underwriting and credit, they can pretty much do everything in-house, so that we do all of our underwriting, credit approval, closing, disbursement, everything for those loans at Live Oak Bank. The structure for those loans, I also think, are incredibly beneficial, specifically for construction. We can build in an extended 36 months of interest only for those loans. They are full 25, technically 26 years with construction, fully amortizing loans. We build in interest reserve to pay the loan back during construction and operating capital to help folks through lease up. So really, for those loan types, a lot of times the only thing that the customer is really bringing to the table is their equity injection. The loan should really help carry them and the business to the point to where it can break even. Really, outside of that, I think the benefit of that loan is obviously leverage. It can go up to 90% financing if it's your first time in the industry. And then if we are kind of looking at an expansion opportunity for someone who's a little bit more seasoned, we can go up to 100% financing with that loan type. The downside of SBA is obviously the rate's going to be a little bit higher because you're looking at higher leverage as a product. 504, very different structure, actually a little bit lower on the rates right now with the debenture portion. Those have a couple more hands in the pot. We can go a little bit higher, up to around 15 million in loan proceeds for those loan types. Those do have a certified development company and the SBA that we work with directly. So again, a few more moving parts with a 504, but there are some benefits there as well. Downside of a 504, I would say, is that the prepayment penalty on the debenture portion is quite a bit higher than what we would be looking at otherwise. But I don't think, I think if anything, especially if it's someone who is brand new to the industry, who's really green, does not have experience in self-storage and it's their first go, I think an SBA loan is one of the debt options that would be really favorable, or at least one to keep in mind, just because of the leverage point. And, the benefit of the SBA program is to help folks start small businesses that maybe aren't in that industry yet.
Thank you, Amber. And I kind of piggybacked two questions for you there, but it just rolled right into there. Neal, do you have anything to add? Do you have a preference of a loan type, or is it dependent on each project, or is it dependent on the economic climate? What are your thoughts?
That's a great question, Amy. I think I would break it up into a little different analysis. You have the development loans that are really based on pro forma and cost and lease up and the economics of that lease up. And your choices there are a lender that offers an SBA program that has everything that Amber indicated: higher leverage, a little higher interest rate, but a little more lenient towards those that are new to the industry. And they also have, sometimes balance sheet loans, loans from their on their books they're going to be more conservative, but they're going to be lower rates. So where Amber may be able to get to 80 to 90% or even 100% of cost on a new project, a bank may offer 55 or 60% loan to cost, but at 2% lower interest rate. So it's a trade-off. And development loans are usually interest only, fully recourse, interest only for three years usually. And then the second part of that is permanent financing, which is totally different parameters. Amortizing loans and really based on historic operating income. So those are, and we could talk more about those type of loans because there's a broad range, and I don't want take over the whole conversation. But that's really the way we should be looking at it, is really development loans and permanent loans.
Thank you for clarifying that. Shawn, did you have anything to add as well?
Not really. I think both Amber and Neal did a great job summarizing it. I think as you listen to them speak, you're hitting on why we have a job, right? So there's a lot of moving parts that are going on as you start talking about financing. And, Amy, our job is to talk with the client, understand what their objectives are, both from economically as it relates to the project, also in terms of time frame. Somebody that's going to build a project and sell it at certificate of occupancy may have very different considerations from somebody that's going to build a project for their retirement and they're going to hold it forever. And I think Neal hit it right on the head. It's very, very important to differentiate construction financing from permanent financing, and then there's sort of something in the middle, which is often referred to as bridge financing. So understanding the dynamics of the project and understanding what products are going to be applicable to a given sponsor is a big portion of what we spend all our time doing every day.
You make a good point. It's almost like a feasibility person, unless they understand exactly what the area is, the project, and have all the information, they can't even begin to start making recommendations, and a lot of times it's not even just the location, does that pan out, but unit mix. I get a lot of people that call and they want to jump the gun already to, can you tell me how this should be laid out and what the unit mix is? And it's kind of like, no, they need to understand the entire project before they can tell you what direction to go and if it even makes sense. So thank you for that.
One other thing I would add is, as we're talking with Amber, I think it's really interesting to point out that just about every lender in the country can offer loans through the SBA or Small Business Administration, but some lenders do it really well and understand self-storage as an asset class. Mm-hmm. Other lenders may not. So I think it's important for clients when they're thinking about choosing a capital provider to make sure that not only does the lender understand the loan program and the SBA and how to be able to administer it if they're going to go into the SBA, but then also you have the secondary consideration of making sure that lender understands the nuances of self-storage, because I can't tell you how many times we have clients that come to us and say, yeah, I already went down the road with the SBA, they told me no. And when you dig into the project further, or the example further, you figure out that it's not really the SBA that said no, it was the lender that said no. And the lender can say no for any number of reasons, because the credit officer's in a bad mood that day could be a reason that they said no. So it's very important to understand, is your project not qualified for SBA, or did you just work with a lender that didn't want to lend on your project? And I think that's something for borrowers to understand.
Really, really good point. Live Oak is what's called a verticalized lender, which, you guys already know that, but I think it's really important that we do only focus in one industry so that we really understand the nuances within that industry. We can form great relationships with advisors and brokers, third parties that the customers are going to work with, that they probably need some hand-holding on, and understanding, who to contact when going through the approval process and the financing process, coming up with unit mix and everything. So I think I think it is a really, really important piece. I think a lot of lenders, if they don't really understand storage, may kind of lump it in with just commercial real estate, which is it's very much not. So I think it's either way very important to work with a lender that understands the industry that you're in.
Well, as a testimonial, you are a good choice, Amber, to be on this call because Live Oak has earned their stripes in the sector. And when we went to go visit Live Oak, opposed to the reputation of SBA has with many owners and borrowers that you'll never get over the finish line. You have a proprietary software that actually has a speedometer next to each of your originators to keep track of how fast you guys are going, which is kind of scary and a little from my perspective, but also good from a service provider perspective. So
We do. We try to make sure that we're handling our SBA loans, at the same kind of reasonable speed that we would a conventional loan. And we do so many reps of those types of loans that we know them, like the back of our hands. So it's a whole lot easier to move through that process since we know what to expect.
Thank you. This kind of leads into the next question. And I'll give a quick definition again for those that might be listening that haven't heard the definition we have for Class A boat and RV storage. 4 simple things. It needs to be gated, fenced, paved, and covered in some manner, whether that's canopy or enclosed. And then anything on top of that has a technology like a Noki is going to be an A+. Reason for that, all of these things that seem simple, but you're dealing with folks that are buying multiple $100,000 toys. They want them secured and protected, and they are willing to drive a little further for it, and they will pay for the conveniences. So that kind of puts it on the playing field. But back to the question I wanted to ask. Are there advantages to trying to get financing for a Class A boat and RV facility versus traditional storage? Where do you see, I'm sure there's some good and bad, but where do you see it playing with the ease of trying to get a traditional storage financed? Who wants to take this one up?
I'd love to.
It's a very open-ended question.
Love to hear
Yeah.
you guys.
We'll all take it. No, go ahead. Whoever wants to go.
Shawn, you start this one. Go ahead.
Yeah, okay. Well, I would definitely say yes. I mean, when we talk about boat and RV storage financing, I think you need to think of a spectrum, right? So, Amy, what you're talking about is on the far end of the improvements spectrum with a lot of amenities and technology and things that lenders like. On the other end of the spectrum is a parking lot in the middle of a cornfield, which, you can understand why lenders have a hard time because the way that they want to look at that deal is land value. If you have a big piece of land that has a lot of vehicles stored on it, but no improvements, it's very difficult for a lender not to be concerned that the guy next door with a equally vacant piece of land could immediately go into the business and start cannibalizing your tenant base. And so they want to tend to look at those deals closer to a land deal than an improved piece of commercial real estate. So it makes our job much easier when there are improvements, because if you think of the very far end of the improvement spectrum, you could be talking about essentially self-storage buildings that just have doors that are big enough and heights that are available to accept large vehicles, but there's really no reason you couldn't put whatever you wanted in that unit. So it's very easy to argue with a lender that that's really just a self-storage deal with very valuable contents rather than, as we like to joke in the industry, junk in the units. But I definitely think that when you're thinking about improvements, it's important to think along the lines of the spectrum, and the further you are to the improved end of the spectrum, the easier it will be to obtain financing. And that goes both on the construction financing side, and then ultimately when the deal is going to go into permanent debt land. A deal that is going into permanent debt land that does not have a lot of improvements may have less options available to it than a deal that is fully improved and Class A.
So I would
Oh, go ahead, Neal.
I would add on to that I agree with absolutely everything you said there. You know, when you can see visual improvements versus a gated paved lot, it's going to go really far for lenders. And in terms of boat and RV, it's amenities too. If there's a waste station, a dump station, and a wash area, and you know if they have propane and ice machines and all the extra, you know, and obviously cameras are key if they have on-site management, all those, and certainly the canopies, three-sided canopies or executive valet, you know, these things add to the facility, right? But I would add two points. You have to kind of thread the needle here because borrowers, owners can get too fancy, right, with all the improvements and all the amenities and go over the top where the economics don't work. So owners kind of have to play that balance of how could they get you know, a facility but still make it profitable, right? And then the other part of the equation is, you know, asking if boat and RV is easier to finance than self-storage. It's not. You know, there's just not, you know, self-storage, there's 55,000 facilities. Boat and RVs, there may be 1,500, 2,500, depending on who you ask. And maybe there's 12,000, 10 to 12,000 hybrid self-storage that has some component of boat and RV included, right? And so the A quality boat and RV is certainly more compelling than B and C, but it's not quite the same quality or same ease of financing as an A quality or B quality self-storage.
Is there anything you would recommend to borrowers that could help paint the picture of what's happening in the Class A boat and RV storage market to potential lenders? And you make a good point. I mean, just 3 or 4 years ago, there was hardly any data. Now, you know, StoreTrack and Yardi are definitely catching up on what's going out there. But before, you know, there wasn't a lot of places you could go to rely on. You could do your feasibility study. But is there anything that you would recommend to a potential borrower that can help paint the landscape to a potential lender?
Yeah, I think what Toy Storage Nation is doing helps a whole lot. I mean, when you start digging into the industry and learning how many boat and RV units are actually out there, and not units, but vehicles, and the amount of adults that actually have and own and operate vehicles, and the amount of HOAs and that don't allow them. When you start digging in, there's a reason why you saw there was a niche here, and that we've seen significant investment growth over the last, 3 to 5 years, particularly in this sector.
Thank you.
Just to piggyback as well off what Neal was saying, I think it's really safe to say that myself and our self-storage team, we understand that there's a huge demand, but it really does just come down to finding the right project. Again, just as Neal said, I think finding that balance with a Class A facility is really important. But the demand obviously is there. I think that what you guys are doing, providing education, you know, the ability to network with other folks that are both trying to get into the industry and current owners is incredibly important and beneficial.
You know, Amy, I think what you're seeing is an evolution, right? So Neal, you can tell because he has less hair than me, has been doing it longer than I have, but I've been working in this industry for, I don't know, 18 to 20 years now. And when we initially started focusing on self-storage, both Neal and I, it was because it was very difficult for owners of just traditional self-storage properties to obtain financing. And if you look at the evolution that the industry has gone through over the last 20 years, today, self-storage has gone from 20 years ago being sort of a afterthought, really arguably not even considered commercial real estate. It was, you'd hear people say things like, oh, it's a land play, it's it's not the highest and best use, eventually something will replace it. And you hear those kinds of comments today, and you laugh at that because we understand how institutional the market has gotten. And I think what you're seeing in the boat and RV storage space and other hybrid now self-storage sort of hybrid asset classes is just a continuation on the evolution of that spectrum. So one of the things I think that's definitely driving it is the cost of these vehicles today is absolutely astounding. I mean, if you walk into a Mastercraft or a Ski Nautique dealer and you look at a modern wake surf boat, these boats are $250,000 to $300,000. So you can be certain that the person that hooks that up to their vehicle and tows it away is going to be concerned about where they're putting it and how safe it's going to be and how easy is it going to be to get in and out of there, because we're going to be using this vehicle. And it's the same thing with campers and RVs and and the other thing I guess that goes without saying is COVID really put an emphasis on that. So when the world shut down, everybody was looking for something to do, and the RV option became front and center for a lot of people. You think about that. Not everybody can afford a lake house, but some people and many people can afford an RV, and that's their respite. That's where they go. That's where they spend their family time. But then there's the other rest of the year that they're not using that, where it needs to reside someplace, and the driveway is not always an option, and people don't have pole barns or 15 car garages to put their camper in. So what you're seeing, I think, is just a sort of an evolution of self-storage as it's evolved and become institutional. You're seeing sort of hybrid asset classes come out of that.
Thank you. Yeah, we have some sort of calculation we did about a year ago that it would take at least 5 years to meet the demand of just what's even out on the market right now, and they continue to come out. And the other thing JoBeth had taught me right away is, and again, love traditional storage. Whenever I'm talking, I'm never bashing traditional storage, but one thing she made the comment on is, someone goes and buys an RV, say they sell it, someone else needs to buy it and it needs to be stored somewhere. So the overall inventory on the market doesn't go down. Whereas in a storage unit, someone may have been having grandma's rugs or something, and they go and throw them away. Now you've got an open unit. So the other perk to this market is the clientele that you're dealing with. You're not going to be chasing them for money. A lot of times they're writing the check up in advance and they're happy. They're coming to go on a vacation, or they're coming back from a vacation. And so you talk a lot about, kind of the perks of this market and where it's going right now. I'm going to go to kind of a nitty-gritty question, because I do get this a lot. What type of documentation to save time in this whole process? If someone does have a project that they've kind of outlined, what types of documents are you going to need from them? A potential profit loss statement, a balance sheet, any kinds of personal income taxes, that type of thing, credit reports. What are you looking for when someone comes into your office and basically will have a project outlined? What kind of documents should they have in hand? Amber, do you want to go with that?
Yeah, I can go ahead and start. Just sent a couple of these applications out today, so it's fresh on my mind. So for us, it does depend on whether it's SBA or conventional as to a couple of the documents we're going to request, but for the most part, there are I think a really good number of similarities. So just as you had mentioned, personal tax returns, typically around 3 years of those. We want to get a profit and loss, balance sheet statement, and debt schedule if they already own any self-storage, especially, but also any affiliate businesses for this, specifically for SBA. And then we have a couple of internal forms as well, personal financial statement, personal information forms, bank forms that people would typically be used to filling out with their bank to get a loan. And then from the conventional side, a lot of times we're working with funds or private investors. So we like to get a really good idea of what that track record looks like for the fund or for the investors or the sponsor. And really from there, just real estate owned schedules, business holding schedules, things like that, as opposed to collecting tax returns if we do have a pretty massive amount of entities that we're working through for that owner.
Is there any type of documentation that seems harder for you to get from folks than others?
I think
Is
it
there
depends.
ever like something that's like the sticking point for you that you see often, or is it always something a little different?
I really do. I think it's the person, Shawn, Neal. I'd love to get your take on this, but for us, it really kind of depends. Some people really don't like filling out the business holdings or real estate owned form. Some people just don't like filling out the bank documents. Some people it's really tough to get tax returns from. So I think it just kind of depends.
Well,
Yeah, I would, oh, go ahead.
go ahead, Shawn.
Well, I was just going to say, and I think you're probably going to say the same thing. So, a lot of the forms, the financial stuff, when you start talking about tax returns and personal financial statements, balance sheets, stuff like that, that's really more lender driven. So, I think Neal and I are more focused on the front end. When we're putting together a loan package, we're concentrating primarily on the economics of the deal. Of course, we're going to ask those qualifying questions to the borrower. Where's the equity coming from? Do you have the net worth and liquidity requirements that the lenders are going to be looking for? We can outline those. But I'm not interested in reviewing anybody's tax returns. That's in fact the last thing that I would want to do. That usually starts once we've identified a lender and the client is now in process with the lender going through the credit underwriting, where the lender is going to get into that sort of nitty gritty stuff. So from our perspective, we're concentrating on, where's the project? Does the project make sense? What do the economics look like? All those kind of qualifications that are project based. And then, of course, like I said, the sponsor does matter. The resume of the sponsor, the financial condition of the sponsor, et cetera. But those are usually things, if we're looking at putting together a loan package, that's one page in the package is the sponsor information. The other package, the rest of the package is about the project and the financials of the project itself.
Yeah, the only thing I would add to everything that's been already said is to kind of emphasize a little bit more on, given it's a boat and RV sector that we're talking about, is that one page of the sponsor section is a little more important. It can still be one page, but a lender's going to look at your experience, who's going to manage a property, who the track record is, and your strength. Particularly if you're going to a bank, they may look for a depository relationship of 10% or more, and where you're located geographically, your footprint. So, particularly in boat and RV, I wouldn't discount the sponsorship, but exactly what Shawn is saying, Amber and her folks could deal with the forms. We really, it's a necessary evil from our perspective, but we're looking at the economics and putting together the story and trying to structure the deal up front. That's what Shawn and I do for a living.
Thank you.
And I was gonna make a joke that the toughest form to get is the executed fee agreement.
Isn't that the truth? Do you have a preference? And I know, again, every project's different, so I'm putting the caveat, but would you rather see a project come in that they're trying to acquire a BC class facility and they're going to upgrade it to an A, or do you prefer projects that come in that are from ground up?
From my perspective, we do a lot. I think that we really excel in construction financing. We really understand that type of financing super well because volume wise, we do a ton of it. So, I think that that is definitely in our bag whenever it comes to an upfit or just an acquisition with maybe some turnaround or value add to an existing BC facility. I think we really just want to understand where that value add comes into play, and how how the buyer is really going to take where the seller has the facility now, and how we get virtually in some cases from point A to point Z, understanding how their projections come into play in comparison to historicals, things like that. So I think it's very project specific, and it's very based on the supply demand analysis in that micro market, to really understand how that value added or that turnaround of the facility is really going to take place and catch hold.
Yeah.
I think
I
it
would-
depends. I'll take a crack at this one, Shawn. I think it depends on where we are in the cycle of what lenders are, how risk averse lenders are. And I would say right now, lenders are fairly risk averse. And they do have their option of where they want to place their money. And so value add deals in general are a little tougher, in my opinion, to get done today, because you're selling, all right, here's a project that either is going to be upgraded or broken, and we're going to change it to be this great, Class A property, or we're going to improve it, right? And I could tell you, we've had self-storage properties that, you have an expansion and the expansion is half leased up. And we say, well, we have the first phase that's fully leased up and the second phase is half leased up. This should be a no-brainer. And I can't tell you how many lenders will respond to that and say, well, call us when it's leased up, because they don't want to have to go into committee and explain that dream. So in times where, past cycles where, lenders are just looking to place money is easier. But I would say right now, it's tough to get value add deals approved, in my opinion.
Thank you, Neal. Shawn, do you have anything to add?
Yeah, all I was going to add is that I think that a project with existing cash flow just has more options. So if you just think through it logically, a construction deal needs to go to a construction lender, and you're limited to construction financing options. If you have a project that has some existing cash flow, there may be other financing options that could work depending on how much cash flow is there and what the existing project looks like. So it's a situation where there may be more lenders available, and therefore if there's more lenders, there's probably more capital. So it can provide some additional options.
Thank you. I know we've only got a few minutes left, so I'm going to cherry pick my questions here. Other than just traditional bank lending, what other types of financing options are you seeing out there, whether it be private equity funds, funding, seller financing I've even heard of? Are you seeing other types of things happening where funds are starting to come in and try to be a part of this?
I think you need to separate equity and debt. So when we're talking about private equity, we're talking about crowdfunding, et cetera. That's really on the equity side of the capital stack. So that's where the sponsor equity is coming from. And then, of course, on the debt side, which is the money that you're going to borrow from a financial institution, a capital provider, there are many options available today. So as Amber focuses on, you have your SBA products, you have conventional bank products, you have credit unions, you have, when we start talking about permanent financing, then you're layering in some additional options like the CMBS market. You're starting to talk about Wall Street products that can apply. So there are many options available today for projects, and again, just not beating the drum, but I think this is where it's very important for a sponsor to talk to somebody that understands all those different products and be able to be educated on what the possibilities are. Because if a client comes to me with an existing project that's stable, I'm going to probably have different recommendations than if they come to me with a ground up construction project. So I think that, those are the things that we like to talk about with the clients.
Anybody else want to add something there? No?
I meant on seller notes. I mean, I think I'm personally a big fan of tandem financing with acquisitions. If the seller has the appetite to come in with, some debt that's going to be really favorable in comparison to bank debt right now, I think that it can be really beneficial both to the buyer and to the seller, and to the bank. So kind of all parties, because the seller can, if we're partially financing, the purchase with a bank loan and partially financing with seller financing, the seller gets a little bit of both worlds. They get a lump sum payoff, but then they also get continued interest payments. And then the buyer, gets both bank financing and they get a seller note at a lower rate, usually, really extended terms, that they can talk with the seller with to come up with, an idea of what they would find favorable or beneficial to them. So I like the idea of seller financing if the shoe fits for the project.
Well, the only thing I would add is I think Amber and Shawn hit it on the head. Shawn, there are so many different levels and capital sources out there, and a borrower might go in thinking that they want one thing, they want the lowest rate, but once they start to talk to Shawn or myself or Amber or any of the other professionals, there's other flavors, and you really have to take a loan product as a whole. And maybe what they find out by going to market is they compare a credit union to a debt fund, to a bank, to an SBA, and then they get their options and really see on paper what really fits their objectives better. So it's important, and it's great that the capital markets are open for business even at higher interest rates. And I actually don't think the interest rates are coming down much, but hopefully a little bit, particularly on the variable rate side. But the important part is the capital markets are open for business, for boat and RV storage as well as self-storage.
Thank you. With regards to when folks are coming to you for suggestions, what are your thoughts on, adding green, meaning solar, renewable energy? I hear about that helping with the cities all the time. And I understand there's all kinds of, if you're in the right state, there's all kinds of things that can be done, but you've got to be in the right state. Do you ever recommend adding a component for that? Does that help in the financing process at all? And the other is, do you ever recommend bringing an additional partner in to help secure the financing? I mean, partner into the project too. So does anyone want to take that? I know it's two separate questions, but I figured given timing, this was probably it.
I'm happy to get it started. I will say we do, we've seen, especially with boat and RV, I feel like there is a good opportunity to use the 504 green program if there is going to be solar involved. Just as you mentioned, Amy, I think that it really depends on the market that you're in, the state that you're in, as to how beneficial that's going to be for you long term or even short term. But I do think that there's definitely some benefit there. From a financing perspective, it doesn't change a whole lot, other than I think there's a balance to the costs versus the expenses that you're going to see with the difference in solar. And then in regards to bringing a partner into the project, absolutely. I think it comes down to the person and how comfortable they are with the idea of letting go of some of their equity and ownership in the business. But especially in situations where we may be working with one person who's brand new to the industry, who may have a mentor that's willing to come in and kind of help through that process, I think it can be, hugely helpful to our customer to have a partner, or if we're working with a situation where maybe more liquidity is needed in order to get the bank comfortable, even post-transactional liquidity. Sometimes we'll look at that as an option.
Thank you, Amber. Shawn or Neal, did you have anything to add?
Yeah, I won't address the green part. I think Amber did a nice job, but in terms of partnership, certainly there are times when newer owners or owners that don't have as much wherewithal the benefit of bringing in investment partners makes a lot of sense. It's just when you go down that route, just make sure that your investment objectives are in line, that you don't have one partner that's looking at disposing at an asset, certificate of occupancy, and another investor that is never looking to sell the asset. Now, I know that's far-fetched, but believe it or not, I'm sure that Shawn and Amber could tell you stories of investor feuds because there's different objectives. So just make sure that if you go down that road, that you're in line.
Thank you, Neal. Shawn, did you want to add anything, or did Amber and Neal?
Yeah, I think they covered it. The green part of it is not so, I mean, it's just another complicating factor in the deal from my perspective. So if it makes sense, and the economics make sense, of course, we're not going to dissuade somebody from doing that. But from my perspective, it's just, it's almost now adding another layer of complexity into something that's already complex. So I think that's really all I have to say about that. It doesn't really change much from, the lenders that we're going to go to. I do think on the SBA side, they have some exemptions available for people that do incorporate green components into their deals. On the adding investors side, we definitely make recommendations all the time to sponsors that they need to shore up the sponsorship, and that they're going to need to go find a partner.
Thank you. This is my last question, and I waited till the last because I know if I asked you right in the beginning, you'd probably just turn off the recording. And I put this with the caveat that I know it varies greatly, but on average, or maybe just tell me the shortest time you've seen and the longest time you've seen it take to secure financing, if given the project is viable, right? You've looked at it and said, okay, this makes sense. What's the time frame someone should expect this process to take to secure financing? And again, I know I just asked again a very open-ended question. Anybody want to grab that one?
Well, you brought the conversation full circle, because I think one of the first questions you asked is when should they bring in an advisor? And so I think the answer to your question can only be, it depends on when we're talking about the starting point being. So if the starting point is the day after I drove by a piece of land and saw a sign that said it was for sale, the project timeframe is going to be very different than if they come to you with a package that they've already secured the land, have all their costs in line, have all the information, and they're ready to actually go to market and start talking with a lender. But I would say if we're using that as the starting point, so we have a viable project that's ready to be shopped into the lending community, I think you're talking about 90 to 120 days. Can a lender get through that faster? Of course. Lenders can go, depending on the loan product type that you're in and who the lender is, could be anywhere from 30 to 45 days, in some cases faster than 30 days if it needed to be. But of course, we need to leave time for packaging the loan. We need to leave time for going out and shopping. How long do you want to shop? Do you want to shop for 3 weeks and talk to 30 lenders, or do you want to shop for 1 week and talk to 10 lenders? And then, of course, one of my favorites, and I'm sure Neal will appreciate this comment, and Amber, is sponsors love to do the old hurry up and wait. So when they're in a rush, it's nothing can happen fast enough. And then when all the forms hit their desk and they have to fill the forms out and provide all the information that the lender requires, things tend to slow down significantly. So the sponsor has a lot to do with how fast you can get through a deal. If they pick up the paperwork right away and get it all done and completed and turned into the lender in 2 days, it's going to abbreviate the process. If that takes them 2 weeks, then of course, you can't complain about why it's taking so long for the financing to show up. So at the end of the day, it is just that. It's a process. Everybody needs to work through it. There's a lot of people that need to weigh in. There's legal teams that are involved. There's appraisers, engineers. There's all kinds of people that need to touch the deal. And that all takes time. And so, depending on what's going on during COVID, for example, it was taking very, very long time to get deals done because you couldn't get anybody out on site. Today, with the world sort of operating at normal pace, I think I've kind of outlined what you should expect.
So I'm gonna just dive into a subset of what you just talked about, Shawn. And it's the shopping part, the 3 weeks of shopping or whatever it is, right? And Shawn will appreciate this because he knows this. You have some lenders that'll kick back a quote in 2 days. And then you have other lenders that ask a bunch of questions and more questions, and then they take it to committee for a green light, and then they have more questions, and then they finally issue a term sheet or some quote. And so you have a quote that's been out there for 3 days that they were the fastest one out of the gate and they gave you terms. And then you have somebody that's done a whole lot of internal due diligence and feels really good about their quote, but it's 3 weeks later. And who do you go with? And the answer is probably somebody in the middle, right? But the reality is you don't want to go with necessarily with the guy or gal that just gave you a quote in 2 days, because you might go through the whole process and 6 weeks later you get a no from the committee. So, it's not always the fastest. It's really who's going to deliver at the end of the day too, which is part of that whole equation.
Great point.
I
Amber,
could not
do you
agree
agree?
more. I was just gonna say I could not agree more with both Shawn and Neal. I think, I mean, timeline's really gonna vary. In a lot of it does come down to how far the project is along in the process. So if we have a full package dropped on our desk with a fully entitled piece of land ready to go, it looks very different than someone who's 9 months out from getting permits that we haven't really got much in the way of documentation from. So I think that it just kind of depends on the project scope and the guarantors. One thing I will say is if you are working, if we're in a situation where we're working with multiple personal guarantors, multiple sponsors on a deal, and we're getting some of the same information from those people, so personal tax returns, personal financial statements, things like that. Sometimes we have a little bit of a struggle with getting all of those documents from one of the sponsors day one. And then those documents come in from sponsor 2 weeks later, and come in from sponsor 3 2 weeks after that. So I think especially in the situation where we do have multiple sponsors, multiple guarantors on a project, having everybody on the same page as far as submission whenever it comes to those documents can really be important, because a lot of them do have a time frame on them. That's really the only thing I'd add, but definitely fully agree with Neal and Shawn.
Thank you. Thanks the three of you, and I know I have taken more time than I initially said I would, but this was great information for folks. Before we go, if we could just go around, I want to make sure that you give your name again, your company, and your contact information. And if there's something that you feel is important that we didn't cover, a piece of advice or something like that, feel free to add that in as well. So Amber, let's go ahead and start with you.
Yeah, so my name is Amber Crucian. Again, I'm a loan officer with Live Oak Bank. My phone number, you can reach me at 336-817-7754. And my email is amber.crucian@liveoak.bank.
And Neal? Thank you, Amber.
My phone number is 847-922-3750. And you can reach me at ngussis@stratprop, stratprop.com.
And Shawn?
My name is Shawn Hill. The company is the BSC Group, and you can find me at 773-517-8504 or shill, SHILL, at thebscgroup.com.
Thank you. And I'll give my contact information real quick. My name is Amy Bix. I am president of Toy Storage Nation. You can reach me at 602-909-3910. My email is amy.bix@toystoragenation.com. Toy Storage Nation is an education media brand. We really promote and advocate for Class A boat and RV storage. We have workshops, tons of content, articles, case studies on our website. We obviously do this podcast. We just try to provide resources for education in this particular market. You can see everything at toystoragenation.com. I want to thank all three of you again. We're very fortunate to be able to pick your brains and your knowledge and expertise. So thank you for being with us today.
Thanks for having us.
Thanks.